If you don't own the hottest of the hot stocks in this market, you absolutely cannot make a dime in this market. I got a bunch I want to react to in this video here today. I thought I'd put this video on the reaction channel because I just want to react to a ton of things going on in the market. If you really enjoy stock talk, you're going to really enjoy this video here today because we're just going to talk about a lot of stocks in this video and kind of some dynamics I'm seeing in this market, really with just a few certain stocks, and what's going on beneath the surface is pretty incredible. And then we'll talk about how to kind of capitalize on the situation for the long term. Okay, I appreciate y'all joining me. I'm in New York City right now in Manhattan, so appreciate y'all joining me for this one. Make sure you smash, make sure you subscribe. Okay, so Nvidia up another 3.5% today. Let's just call it what it is. It seems like Nvidia goes up every day, does it not? Every single day, it seems like you wake up, Nvidia's up another 3%, 4%, 5%, right? And it really never fails. It's like it never fails. The stock is up even more after hours right now. Stock's now up 175% year to date. Year to date with this one. Absolutely incredible move in regards to Nvidia. Don't be surprised if it hits 150 here very soon, and it probably goes to 200 in the short-term cycle before things, let's just say, calm down in regards to the kind of the stock price move, right? I mean, the move's been so incredible that even in the public count, adding those shares back in March, which was just 3 months ago, already sitting at a 55% gain on those shares, and that's in a 3-month span. I mean, if you could make 55% in a year on a stock, not even a year, if you could make 55% return on a stock in a 2-year basis, you're knocking out of the ballpark. Like, that's amazing. You know, 55% in 3 months, you'd be flipping my flapjacks. But that's what we have going on, right? You look at a stock like ELF, up another 9% plus here today, pushing $213 a share. That stock's now up over 50% year to date already. ELF Beauty is maintained at a buy by Canaccord Genuity. So look at this. They just raised their price target big time. They say the stock's about to go up a whole lot more. They think it's going to go all the way to $250 a share, and that's within the next 12 months, right? And before they were at $214, which is basically where the stock's at roughly today, right? Now, in regards to ELF on a shelf, right? Oh, by the way, you might see random photos here and there. Yeah, it's a nice pizza place here, and that looks very, very, very delicious. So, ELF on a shelf, if you look at trailing 12-month P, we go to 1000xstocks.com, you look at forward P, you look at the 2-year forward P, they all look high. Let's just call it what it is. The trailing 12-month P is at 85, market's usually trading 20-ish, somewhere around there, right? Forward P, 74, 2-year forward P is 52. So all those are way above the market, yet, even though the valuation is way, way above where the market trades at, it doesn't matter in terms of the stock price here right now, right? The bottom line is, if an analyst comes out and says buy, people go buy the stock, and they buy the stock, and they buy the stock. 9% here today. There's no shortage of an appetite for ELF stock, despite the valuation metrics on this stock being stretched. But you also can't just say, well, trades at a high PE, that means it's not a good deal. Well, it goes bigger than that. The company really backs it up with that earnings per share growth. Look at the trailing 12-month earnings per share growth. It's 100% plus, triple digits. It's insane. I mean, it's not even in the same league as an average stock in the market. Current year expected earnings per share growth, you know, they have it pretty low as far as analyst expectations go, but don't be surprised if they come in and smash that. And then next year at 40% plus for this one. If you look at revenue growth, look at the trailing 12-month revenue growth, 77% roughly. Current year expected revenue growth around 40%. Don't be surprised if they beat that. And then next year, 15%. Don't be surprised if they beat that, right? And so you look at a stock like ELF, and one, people aren't getting caught up in the valuation. It's got the momentum in the business and the stock. Two, they really come through with the numbers. The numbers are extraordinary. Now, in regards to why did they go ahead and upgrade the stock, right? They upgraded to $250 from $214, which implies a 28% increase from the stock's closing price on Monday. Anderson also reiterated her buy rating, but why? Well, here's what's going on. She says current tracked sales data looks great. Untracked channel sales have been growing at triple-digit rates, and ELF is awaiting the boost from major shelf space additions planned for this summer, Anderson wrote in a research note. This positions ELF for another year of beat and raises in our view. And who told you several months ago Elf is positioning themselves for a beat and raise year again. I told you guys several months ago this was going to happen, right? And now these analysts are starting to come to that conclusion. And so this is the first one to come to the conclusion I came to a couple months ago, and they're basically all, in my opinion, going to come to that conclusion before it's all said and done, which positions Elf stock price in a very, very good way overall, right? Now, in addition, Elf is focused on expanding its skincare line. The company acquired skincare brand Naturium in August 2023 and also hopes to branch it out into existing Elf skin line. With management also highlighting Naturium expansion into Ulta starting this summer, we believe there's still a lot of room to grow. And yeah, no doubt with that brand. I mean, they got probably 10, 15 years of growth easily ahead in that brand, if not a lot longer than that, right? And so you've got two brands really now with Elf that really have almost untapped, unlimited potential in regards to this one overall. And so Elf remains just a red hot stock. And it seems like that one just goes up and it goes up and it goes up, which is kind of like Palantir. Look at Palantir. I mean, if you don't own this stock, you have nothing but tears in your eyes because the stock is like an Nvidia. It seems like every day you wake up, it goes up more and more and more, up another 3.2 percentage points here a day. The stock's now sitting at a 52% gain this year. 52%. Incredible move. What's going on with Palantir stock on Tuesday? And remember, the stock moved 6% yesterday. Well, Palantir shares closed Monday up 6.15% after this research analyst, Joseph, initiated coverage of the stock with a buy rating and announced a price target of $29, highlighting momentum around the company's commercial business. The research analyst noted that Palantir has significantly improved its profitability and cash flow in recent years. As a result, the analyst is positive on the stock despite its trading with a premium valuation, he said, adding that Palantir is highly differentiated. So that's what I'm saying. These hot stocks, valuations just isn't concerning to these folks because they look at them and they say they got the growth. They got the growth rates. They got the price momentum in the stock. They got the business fundamentals, momentum. And so a lot of these folks say, I don't care that it trades at a price to sales ratio, forward PE, a trailing 12-month PE significantly above where these other stocks trade at. We're buying them regardless, right? That's growth stock investing 101. Adding that Palantir is highly differentiated. The analyst expects Palantir's earnings to grow at approximately 19% per year over the next 5 years. So I would actually say he's not that bullish. That's a crazy thing. He sounds bullish, and his price target's obviously above where the stock is, but this is actually a bearish scenario. I think Palantir's going to blow away that earnings growth over the next 5 years. 19% per year? A 19% CAGR in earnings growth the next 5 years? Give me a break. They're gonna smoke that number. That's not even going to be in the same ballpark, in my opinion. Palantir reported earnings for the first quarter last month, despite beating. And if you're in the private group, you've seen my different scenarios for Palantir stock in those in-depth spreadsheets, right? I mean, that's crazy. 19%. Shh. Palantir reported, and he's supposed to be bullish. Palantir reported earnings for the first quarter last month, despite beating estimates on top and bottom lines and raising its full-year guidance. The stock traded lower. It has since recovered. The software and AI continue to dominate themes in the market. Palantir, due to report earnings in early August, the company is expected to report earnings of 8 cents per share and revenue $652 million. Don't be surprised if they beat those numbers. With all these government deals pouring in, plus that commercial business on fire, don't be surprised. Palantir shares may also be gaining a lift on Tuesday, as Cathie Wood purchased 9,700 Palantir shares in the Space Exploration Innovation ETF. Okay, I don't know about that. I don't know if Palantir stock's really going up because of that. But nonetheless, Palantir just remains an absolutely red hot stock. We're now getting close to a 200% gain on Palantir stock now at this point in time. Now, it's important you understand to look at Palantir very differently. And I challenge everybody out there to look at Palantir very differently, because I think there's still a lot of people looking at what the stock was at in 2022 when it was going through the crash, right? And obviously, somebody like myself picked up a lot of shares. I mean, look at this, 888 shares on June 17th, 2022 is $7.69. I mean, look at those shares I was just gobbling up at these insane prices, right? But I think it's important people don't get lost in that, because I've even got shares I bought even as recently as 2023 in terms of the public count that are at much higher prices, $15.45, $16.50. Now, why was I willing to pay $15.45 June 2023 when we could go back to June 2022 and I was paying $7? Well, guess what? Between here and here, do you know what happened with the company? The fundamentals changed. The fundamentals changed, and did they change for the better or for the worse? They changed for the better in a very, very substantial way. And so when I looked at this, and this is something you guys got to adapt whenever you're looking at stocks, if the fundamentals are changing for stock in a very, very positive way, and you want to be part of that long term, you've got to understand you're likely going to have to pay a very substantial premium to what it was before, right? When I was buying these shares here in June 2022, there was a lot of question marks about where Palantir's growth was going, how the company was positioned in the market, right, with their products. If we go to here, there was no more questions really about growth. It was very clear, like, Palantir's products were a center of attention. Palantir's growth rates were getting back on track and going to get a lot more stronger. It was clear Karp had his confidence back. And so I'm willing to pay a lot more in that sort of scenario. And so, no different than Nvidia. A lot of people haven't bought Nvidia over time because for a long time they looked at Nvidia and it went from $100 to $300. And they said, oh my gosh, like Nvidia is so expensive now. Instead of understanding, well, the fundamentals of Nvidia are massively different at $300 and when it was at $100 in the 2022 crash. Like the AI chips, that's an absolutely insane, growth lever for the company. So these are just kind of things that are important to kind of keep in mind in regards to these stocks overall, guys. And these type of stocks remain absolutely as hot as hot can be. Palantir, Nvidia, Elf, these sorts of companies, right? Now, on the flip side, you've got stocks that are cold as mold and cold as ice. And you know what stock I think of when I think about that? I think about PayPal. The stock's down 3% this year. Like, it seems like every time it goes up, it goes back down. It seems like every time it goes to $65, $67, it ends up back at $59. And then bottoms out, then it comes back, and then it goes down again, and then it goes up again, and then it goes down again, and it all adds up to nothing, right? Stock's cold as mold. Amazon started the year very hot the first month, and then since then, it hasn't done a thing. And you think Amazon's such a massive company, such a massive market cap, but it was very hot at the beginning of the year. But now the stock is actually just flat. It's not doing a dang thing. Look at a stock like Shopify, one of the best long-term investment opportunities I see in the stock market, right? Of just thinking about a company that I'm so certain is going to be such a massively bigger company, 5 years from now, 10 years from now than it is today, with a great income statement, great balance sheet, and just great business prospects. But the stock is down 15, 16% so far this year. The stock's down 3.4% here today. For what? Nothing. It's just people don't want to own these sorts of stocks and they remain cold. Meta's even gone cold. Meta had a great first month of the year, but since then it hasn't done a dang thing. The stock's also just kind of an Amazon. It's not doing a thing. And so don't get confused with Meta's 42% move up year to date. Let's be very clear, that all basically came the very beginning of the year. And since then, this stock can't do a thing. Can't do a thing, right? Now, how do I look at this? I'm a big, Meta shareholder, $800,000 plus in the public count. We're up $647,000 on those shares. How do I look at this? Is this like a warning sign to me that like, oh boy, like Meta's topped, right? So when I look at this, I'm very understanding of Wall Street getting caught up into really just wanting to play the most momentum, and Meta does not represent the most momentum at the market, right? And so that's a short-term phenomenon, but you have to differentiate between the short-term and long-term. The valuation metrics around Meta scream undervalued. The growth metrics around Meta scream buy. It's simple. And so Meta, this is another one. A lot of people want to look at this stock and they want to say, it used to be so much cheaper. Sure. Yeah, it did used to be a lot cheaper when we went through the crash of 2022 and these stocks were getting hit 50, 60, 70%. But also, if you look at where Meta's numbers were at that time, what was going on with the business model, it was overbloated, it was inefficient, and they weren't moving fast enough. And we don't have those problems now. The company's a lean, mean, fighting machine. Their revenue growth is far better than it was back then, the earnings per share growth. And so I look at this and I say the fundamentals of Meta all look great. But there's no doubt the stock's cold. It's cold. It hasn't done anything in basically 5 months, right? So just a little food for thought in regards to that. Now, in regards to Meta, I bought shares all the way back to 2018 in the public count. And so you just got to have a little bigger time frame in regards to that with these stocks, right? And I have shares in the public count all the way from November 2022, right? Right here, October 31st, Halloween 2022, 650 shares are $93.12. So have a little bigger vision. Wall Street's going to play their games. They might have stocks go cold, and that's fine. But at the end of the day, Meta is very similar to a Palantir, where if you get major dips in that stock, or even a Shopify, there's few stocks in the market I view as if you get big drops in those stocks, you got to take advantage. Meta, Shopify, Nvidia actually on many times too, right? Meta, Shopify, Palantir. I mean, those sorts of companies, if you get it, you got to take advantage. And so, just a little food for thought in regards to that. Look at Win. Win can't do a thing, right? Win stock, I mean, it's down 1.7% for the year. And are their business fundamentals great? Yes. Vegas numbers are great. If you look at the Macau numbers, they're just getting better and better. But what does the stock have to show for it? Absolutely nothing. Absolutely nothing. Does it trade at some crazy high valuation? No. But that's Win. It can't do a thing right. It's cold. Nike, cold. 12% down year to date. Just can't do a thing right. Lululemon, cold as ice. Stock's down 38% so far this year. I mean, my gosh, that's a crash. 38%. I mean, we're not even through a full 6 months of the year, and the stock's down 38%. And you look at some of these companies like a Nike, a Win, and all these famous companies, Lululemon, and you're like, how? How could these stocks be down that much with a market at record highs, right? And you have to start asking yourself this. You look at a stock like Zoom. You would think there's no way Zoom could go down anymore. Like this stock, there's no way it could go down anymore. And yet it's done that. Stock's down over 20% so far this year, down another 1.3%. It's at $56 a share. And Zoom, I mean, here's the deal with Zoom. We can go to 1000xstocks.com and look at the trailing 12-month PE is roughly in line. The forward P is significantly lower than where most stocks trade at in the market. The 2-year forward P looks great on the stock. It's got a very stable business model, trailing 12-month revenue growth, 3%. Current year expected revenue growth, 4%. Next year expected revenue growth, 4%. Is this some sort of knock your socks off growth story? No, not for Zoom. But it's also not trading like that. It's a company with a very stable business model, which is clearly what we've seen now at this point in time, with small growth that trades very cheap and has a grade A income statement, has a grade A balance sheet. But with that being said, if it's cold, people don't want a piece of it. It doesn't matter the valuation, right? Look at a stock like RH. RH, dead money, just absolutely dead money. The stock's down 23% so far this year. It was down about 5 percentage points here today. I mean, that stock can't do anything right. I did a very in-depth video, relatively in-depth video on, it was actually yesterday. I posted that inside the private group, so any private stock group members, check out that video there. That goes all in depth on kind of RH and the blunders the company's made in regards to where the business model's at with the income statement, the balance sheet, some decisions, the management team there, and it's really put the company in a bad position. And we even talk about like what are the chances of bankruptcy, right, in regards to RH, which is something you really never even had to think about. And for RH, there's actually a consideration about like, could the company eventually go BK, or could the company have to be put in a situation where they have to start liquidating inventory to try to, get some cash flow in, right? Which would be very damaging to the brand if they had to do something like that. So anyway, that video is in the private group. And if you didn't know, in my private group, I'm posting exclusive content every single week in there, basically teaching you guys different things. If you want access to that, to apply, join our private group, you can click the pinned comment down there today, fill out an application, and join us in there. You get access to all my courses, exclusive videos every single week, teaching you different stuff, as well as access to my 6 and 7 figure Discord chat. So if that sounds like something that you would be interested in, click the pinned comment and fill out an application down there, okay? UiPath, not a stock I'd usually be interested in, but this one's even caught my attention recently. I've added to my watch list, doing more research on the company. This stock's all the way down to $11. It's lost over half its value this year, 54%. I mean, if I recall, UiPath is a Cathie Wood stock, so whew. But brutal, absolutely brutal, right? Cold as mold. Look at Whirlpool, down another almost 3% here today, down 26% that stock is year to date. I mean, gosh. Look at Estee Lauder. You want to talk about brutal. EL, come on. 23% down year to date. And I mean, that comes on the back of just disastrous last few years for EL. Down to $110. I mean, here's the deal. If the S&P 500 just fell like 5%, I think EL's under $100. I think it's in the double digits, and EL hasn't touched double digits in the longest time. Like, when's the last time EL was under $100 a share? My guess is 2017, but let's take a peek here. I'm very interested in this. Let's see. So EL, let's pull up a 5-year for EL. Oh my gosh, I have Nvidia. Look at Nvidia's 5-year. Oh my gosh. Oh gosh. Some of these stocks have just done very tremendous. Mr. Softy, look at Meta. And then we got the NASDAQ here. We have Amazon. So EL is certainly in the last 5 years, it hasn't been even down in the double digits. So when's the last time? It looks like it was, 2017. Yep, 2017 around summer. Summer 2017 was the last time Estee Lauder was under $100 a share. And man, like I said, S&P 500 goes down 5%. EL's there. EL's there. Brutal, brutal. Just goes to show you how nasty this market is. SoFi, that stock's, it's impossible for that stock to go up, down 33% year to date. I mean, incredible, right? So it's just, that's the way this market's treating these stocks right now. By the way, SoFi was one of the stocks I mentioned in the top 3 stocks to buy under $25 video. So if you didn't get to see that video, check out my main channel. You'll enjoy that one, right? So, you know, I think this is very important what I'm showing you here. S&P 500 percentage of stocks that outperform the index. So if we look here overall, it's a very small percentage. We can call it roughly, last year, this year, we're around 30%. Now, usually around 50% of stocks outperform the market, which actually makes a lot of mathematical sense, because around half the stocks should outperform the market in a perfect world, and around half the stocks should underperform the market in a perfect world, right? It's math. It's just math. So that makes sense. That's why the median is 49%. It makes sense, right? So whenever you have a scenario where we can call it a very small percentage of stocks are actually outperforming the market, it usually means that basically everything's doing bad, but the very largest stocks in the indexes, in S&P 500 when it comes to weighting. And that's exactly what we've seen play out, where over the last couple of years, the biggest, best companies in the market, the ones that people will look, in a different way when it comes to valuation, those ones have performed tremendous. We all know that, right? And meanwhile, everything else, it goes to show you how bad it is. And the last time this really happened, you have to go back to prior to the tech bubble popping, which is a little worrisome from the perspective of, like, what happens if that top of the market pops next year, which I think is a possibility, right? But then you could actually have a scenario where a lot of these other stocks that I just went through and showed you all these famous companies that are ice cold, right? Where those ones actually end up overperforming, outperforming the S&P 500 significantly in, let's say, 2025, 2026, which is a possibility. Imagine rates are going down, and imagine you don't get the major unemployment cycle. I mean, it's not crazy to imagine all these dead stocks that I'm pointing out to you, all these ice colds end up actually way overperforming the market in 25 and 26. It's very much a possibility, while the top of the market, let's call it, doesn't do as well, right? Now, this is very important. S&P equal weight index versus the S&P 500. And you can see we're all the way back to great financial crisis type area here, which makes you say, basically the stock market's in a massive crash, except for the very top of the market, right? I mean, when you got a reference back to the great financial crisis of 08, 09, for something like this is very important. We all pay attention and we all understand what's going on here. You're in a booming market for the very highest companies, but you're in a absolutely crashing market for really the rest, right? And so I'll say this is the most picky stock market I've ever seen. I don't know if you guys ever had a kid that's really picky when it comes to food and they only like to eat certain food and things like that. And the choices are very slim, right? It's like they'll only eat like 10% of food items out there, or maybe less. That's a stock market, is it not? Where investors only want, Wall Street, the hedge funds, they only want what they say is the very best. They only want the pizza and the chicken nuggets. That's it. If it's not pizza and it's not chicken nuggets, they don't want it. And so I've never seen it this bad, right? No, as an investor, you got to differentiate between the short term and the long term, right? Because this is a phenomenon that's been going on for the last 2 years. Is it still going to be going on 3 years from now? No, not in my opinion. I'd say less than a 1% probability. Is this even going to be going on 2 years from now? No, I would say less than a 5% probability. Is this even going to be going on a year from now? Maybe. I would say probably not, but if I had to put odds on that, I would say 60% no, this is still not going to be going on a year from now. So you're going to have a couple of years of this happening, but this is not a long-term trend. This doesn't happen over 5, 10, 15, 30 years, okay? Eventually the market comes to equilibrium, and eventually these other stocks do a lot better, and sometimes the big ones don't have these incredible parabolic runs forever, and then those runs end, and sometimes it can end in tears where they actually crash. Sometimes it can be a slow bleed, right? Everybody thinks Nvidia is going to have some sort of major crash in the stock. It's a possibility, but it might not. Nvidia could peak in 2024. Let's imagine it peaks at $150 a share, $200 a share later this year, right? And then let's imagine their business, just continues to slow year after year after year. So they have to kind of, keep trying to justify that the PEs if the growth rates are slowing. And so you could look at a situation where Nvidia stock just kind of flatlines or bleeds for the next several years after that, like let's say 25, 26, 27. That's a potential, right? And so you've got to, if you see deals out there in the market, even if they're not the hot stocks right now, take advantage of those. And also, I understand it looks like easy money. Just play the hottest of the hot stocks, play the Nvidias and the Elves and the Palantirs. But usually, if you're just getting in the game and just thinking like, oh, there's easy money to be made here, that's usually when you get slapped in the face and you realize it wasn't easy money. And usually when everybody starts thinking, oh, this is the easy money, like just buy Nvidia, just buy Elf, just buy Palantir, that's when people get slapped. So, don't play it from that. If you love Nvidia because you believe Nvidia is going to be a $10 trillion company 5 years from now, 7 years from now, cool, buy the stock, right? If you think Palantir is going to be a $500 billion market cap, then it makes sense to buy the stock. Or if you think Elf is going to be a $50 billion, $100 billion company, buy the stock. But differentiate between making a long-term decision and just thinking short-term and, oh, this is hot right now, so I'm going to play it for a month and get out. Let's stay away from that sort of stuff, okay? All right, guys, I hope you enjoyed today's video. Appreciate you joining me. A lot of stock talk in this one here today. Pin comment down there if you're looking to apply to join my private group, get access to exclusive content from me, exclusive videos, teaching so many different subjects, the course curriculums, as well as the Discord chat. Much love and have a great day.